investor friends, I'm Michelle Markey, and as you know, the stock market has been selling off in early 2022 as the Fed is looking to tighten and increase interest rates in order to combat inflation of at least 7.5%, and that's only CPI inflation. Some are suggesting that inflation could be around 15%, and this has largely been baked into the real estate and stock markets. So a lot of growth and tech company stocks have been selling off massively, and that's led some to ask the question whether there could be some buying opportunities in the growth and tech and media sector. And especially the two stocks that I'm going to cover today are whether there could be sale opportunities of Netflix and also Google, aka Alphabet. And the last I checked, Netflix was trading at around $390 or below $400 a share, and Google Alphabet was trading around $2,700 a share. So between the both of these, we should check out what are some of the factors and risks associated with these stocks. And of course, I'm just trying to do some high-level preliminary analysis of these companies, and it's not advice to buy or sell these companies. I'm just trying to add to my knowledge base and try to help us be as informed as we can be before we make any investment decisions. And if you're also enjoying being on an investing journey, I'd love if you could please like and subscribe to my video and YouTube channel, because I try my hardest to help us be the best investors we can be. And you can see how I try to analyze companies and evaluate them before I make any investing decisions. So I hope this content is helpful to you, and I greatly appreciate you liking and subscribing, so thanks. While both Google and Netflix have taken a hit to their stock price, they're drawing news headlines for totally different reasons, and Google's stock has been somewhat on a rebound because they recently announced that they plan to have a 20-to-1 stock split after the 4th of July holiday if the board of directors approves it, and that sent their stock price rising up, so much so that right now it's only off about 12% of its all-time high, which was $3,042 a share. And this is in contrast to a gradual decline in Netflix, where a few weeks ago they announced during their earnings call that they're projecting weaker subscriber growth. So that initially sent their shares tanking by 20%, and now they're off 44% from their overall all-time high of $701 a share. So overall, we can see that Netflix is down pretty much 44% to Google only being down 12%. And even though price to earnings ratios aren't that meaningful, we can see that Netflix still has a lofty PE ratio of 36, but obviously that's way lower than what it once was. And with Google, that seems to be trading at a more reasonable, slightly below 24. So at face value, we might think that Google seems cheaper than Netflix if you just look at PE ratio alone, but that's not the full story. And I'll get into why Netflix could potentially be a little bit more compelling than Google right now, because a famous hedge fund investor, Bill Ackman, has recently loaded up the truck on Netflix, as well as I've seen insider trading of Reed Hastings, the co-CEO of Netflix, also adding to his position in Netflix, and we don't see that going on with Google. So these are just some of many factors to consider and to do more research in, and I'll get a little bit more into some of this soon. First off, the bull case for Google is pretty strong, as Google delivered monster revenues in Q4 2021 of $75 billion, and for overall 2021 year, $257 billion, of which $67 billion was free cash flow. And then also they have $140 billion of cash on their balance sheet, and they also only have about $15 billion of debt. So all in all, Google could easily pay off its debt, and they have a pretty strong cash position to make future acquisitions or other kinds of investments to continue to grow their business. So all of that looks pretty incredible, especially when you consider that they increased their revenues 41% year on year from 2020 to 2021, as well as their cloud revenues are also generating pretty incredible returns of around 45 to 47% in quarterly and year on year returns respectively. And then also they have incredible market share in search, where where of course we all like to Google things and people don't really use other search engines as much as they use Google's. And then also YouTube for video content is also on the rise. And so it's no wonder that the future growth of Google is pretty bullish. And I think that Google continues to grow, and I think that there's way more research to do to understand what would be a good buy price of Google, because I've also seen that insiders don't seem to be adding to their Google position, but rather they've been selling more Google than they've been buying. So to me, that's a bit of a warning sign, as well as how there have been some mixed reports of some slowdowns in ad spending. So some are saying that there's reduced digital ad spending, and others are saying that digital ad spending is not slowing down anytime soon. So it's a little bit mixed. So that also warrants for further research to fully see what is the picture going on with advertising, and if it's a cyclical event where maybe some industries are reducing their ad spending, but overall it's not taking a hit out of the ad revenues that maybe Google and other ad platforms are generating. So that's all something to keep in mind and to do more research on. In addition, if we look at the 29 super investors on Dataroma that own Google, 8 of them have been selling or reducing their position in Google, while 6 of them have been adding or buying more of Google. So that's a bit of a mixed bag for now. And then, like I've talked about in my video about stock splits, in general, they shouldn't really make such a difference to a future stock's trajectory. But as we've seen when Apple and Tesla did stock splits in 2020, that caused a lot of shareholders to want to rush in and buy, because it seemed as though the share price was lower, even though the overall valuation of both Apple and Tesla was the same at that moment. For some reason, psychologically, it makes the share price seem more appealing. So it makes a lot of people want to buy the shares. So that's why if you bought Google's share at $3,000, if it splits 20 to 1, then all of a sudden your one share will turn into 20 shares at $150 a share. So mentally, it seems like you have way more shares, even though you still have the same value of about $3,000, notwithstanding if it goes up or down. But that's why a lot of people like to buy in when they hear a company announcing a stock split. And also, companies tend to announce stock splits when their companies are doing well and are expected to continue doing well. So overall, things usually look like they're on the bright side when companies announce stock splits, but it doesn't necessarily mean that it's a buying opportunity. It definitely warrants for us to do more research and due diligence before we were to just rush out and buy Google, because it doesn't mean that whatever price is being offered at this moment is the best price possible, especially if there are some future unexpected events that potentially could make Google's stock price even more appealing than it is right now. And even though it seems maybe appealing right now for some people, it's still kind of close to its all-time high. So for me, I'm kind of waiting for now. And in addition, with the advent of fractional shares, this doesn't mean that people have to go out and buy a whole share. If you think that Google stock price is on sale and you can't afford the full $2,700 for the share price right now, you could potentially buy it at half of that in buying a fractional share like I've talked about. So make sure you learn about the full meaning of what stock splits tend to do, and also that you can buy fractional shares. And I think that that will also help you make better investing decisions. Just like Google thrived in 2020 and 2021 when a lot of people were stuck at home and spending a lot of time on the internet and streaming, Netflix did the same, as it generated revenues of almost $30 billion in 2021, and their subscriber count is around 222 million now, and they also have operating margins of 20.9% as of 2021 as well, and they're looking to generate positive free cash flow this year, which is a pretty good sign. So one of the reasons why their stock price got hit so much is because they forecasted to only have subscriber growth of 2.5 million, whereas Wall Street was expecting 6.9 million new subscribers. So that's one of the main reasons why their stock price got hit so much, as well as how they have to hike prices now. So even though they only hike prices by a few bucks, it's still a meaningful difference. So perhaps that could also be leading to a decline in new subscribers, especially as they have more competitors like with Disney Plus and Apple TV. All of these other streaming services are also nipping at the heels of Netflix Netflix, and they also had a pretty large outlay of cash where they had to spend $18 billion on new content last year. So this is all significant in terms of capital expenditure costs. So it's important to weigh what are the capital expenditure outlays that we're projecting Netflix to continue to have, and why might it be a good buy price now, as to how come Bill Ackman of Pershing Square Capital felt like it's a pretty good deal right now. And I suspect that he might have averaged a buy price of $375 per share. And even though that's not listed anywhere, that's just a hunch to me. But he had a lot of buying activity during the week of January 21 to 25, 2022. And the stock price ranged between the high $390 range to the low $360 range. So that's where I'm just ballparking that he probably got 3.1 million shares of Netflix at around $375. So that's a pretty good discount to what it was trading at its all-time high of, remember, of $700 per share. So it would be good to study why Bill Ackman and Reed Hastings decided around now is a good time to buy more of Netflix stock, and to see why they believe it could be a bullish case for Netflix going forward. And if you'd like to learn why Bill Ackman is so bullish on Netflix, I encourage you to visit his fund's website, Pershing Square Holdings, and read his latest letters and presentations to shareholders, because it details why they made the about $1 billion investment in Netflix. And some of the highlights include how Netflix made a successful transition from being a DVD rental by mail company to video streaming, as well as now they're some of the best producers of beloved content, and also how they're a subscription-based model, which leads to highly recurring revenues and has great future growth potential. And they have economies of scale, which allows them to produce high-quality content. And they also have best-in-class management in the co-CEOs of Reed Hastings and Ted Sarandos. And they also have pricing power derived from the value that they deliver to viewers and consumers of Netflix content. And they also have improving margin expansion, and they also have improving free cash flows. So all of this is going to lead to the benefit of shareholders. So this is part of why Bill Ackman really likes Netflix, and he's a very concentrated investor in his portfolio on Dataroma. We can see that he currently only has 6 positions there, but that's likely to increase to about 7 positions with the addition of Netflix, if not other holdings. So I don't really know what Bill Ackman may have bought in Q4 2021 and also what he may have bought in Q1 2022, but so far it looks like Netflix is probably Pershing Square's 7th position now. So that seems pretty impressive, considering that Bill Ackman is sort of like a Warren Buffett style investor, where he likes to be really concentrated. And if we want to learn more about Bill Ackman's investing style and the principles behind why he makes the investments that he does, we should also check out his 8 principles, or also his checklist as to what makes for a good investment in the Pershing Square portfolio. A few final observations I'd like to make just for information purposes is that I noticed that Google share price is trading kind of double where it was in 2019, and Netflix is trading where it basically was in 2019. So it's definitely something to keep in mind, and try to project where you think the future share prices might be for these companies if you're interested in them. And also, if you're interested in Google shares, you might want to decide if you want to have shares that have voting rights compared to the ones that don't. And Google's Class A shares, known as Google in the ticker symbol with an L at the end, are the voting shares, whereas Google's non-voting shares are Class C, and that has ticker symbol GOOG, or just GOOG without the L. So definitely pay attention to that if you're also interested in Google. As well as, if we look at Dataroma, we can see that among the 9 super investors that own Netflix, that it's kind of a wash between the ones that have been recently adding or selling with their Netflix position, as only 3 have been adding or buying, and also 3 have been selling or reducing their position in Netflix. So let's see if there's any other super investors that may have decided to buy into Netflix in the current quarter, because that would be a pretty bullish sign that more super investors believe in the future growth story of Netflix. So definitely something to keep in mind. And overall, both Google and Netflix continue to innovate in the fields that they're in. And we can see that Google is innovating with cloud and artificial intelligence services, and then Netflix is innovating in the media entertainment industry and continuing to deliver high quality content. And I'm sure both of these will continue to grow their tech prowess and expertise so that this continues to lead to the great products that continue to have a very loyal subscriber base that we all have come to love and appreciate. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. And you can't go wrong whether you decide to buy any of these companies. For me, it's just a matter of price because I'll be adding these companies to my buy wish list, and I hope I might be able to buy them in the future at a price that I think is appropriate. And I hope you have a great rest of your week. Till next time.